What's going on, everyone? My name is Nicholas Merton here from DataDash, and today is September 22nd of 2023. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's video, we've got to sound off the alarm bells, not only for Bitcoin and crypto, but for assets as a whole, as US stocks are starting to signal some serious, significant declines here over the last few days, setting in the lowest price range for most equities since back in June, cutting out all of the gains we saw this summer and leading us with an increase in volatility, the biggest jump we've seen in multiple months. So I want to spend some time to talk about this, why we've been continuing to hit on this point, and what we can prepare for here on out. We've got a lot to unpack in today's video, so if you guys happen to enjoy it, consider dropping a like. It's one of the greatest ways you can support the channel. And let's go ahead and kick off the rambling. All right, I want to go ahead and start with Bitcoin here. Not much to say other than same old here. Continued lower highs and lower lows, and an inability here to come up and retest against the 200 week, which we were able to at least do back here in late August. Now, again, it's important to understand here with these moving averages that whereas they were previously serving as resistance, here in March we cleared through there and we're looking to potentially start making them support. Unfortunately, we're back in the chop zone as the 200-week SMA and the 200-week EMA are starting to diverge from one another. So now this is the near-term kind of support and resistance bands, but I gotta tell you guys, we're not even coming up here to test that. Not to mention, if you can look a bit closer here with the colors, you can see that we've got our blue lines. So these are the 200-day moving averages, and price can't even hold or get above there. And this is supposedly bull market price action in so many people's minds. Again, I don't want to beat it like a dead horse, guys. You know where we stand here in the market, but price action, no matter where you stand, you have to be wondering whether or not we've really got the steam here. If you're even a believer in that narrative of a bull market, even of the halving and all these things, you need to come back to what price is telling you. Don't believe in whatever narrative someone's telling you. Don't believe in what you just want to believe in. Take a look at price action here, guys. There's not much confidence here. Now, I want to continue to kind of explain here why we're coming from this kind of position. We can see here that global liquidity has contracted another $286 billion this week, following the Fed's FOMC meeting, sending signals that they're not only willing to continue raising rates if need be in the future, keeping that open, but also showing that the target rate is going to be held for longer, and that QT, or balance sheet reduction, quantitative tightening, is going to continue here, as it has been doing since back in April. And that is going to force other central banks, if they don't want their currencies to completely devalue, they're going to have to keep up pace with the Fed. It's simple monetary policy 101 here when it comes to not only dealing with inflation, but maintaining currency preservation and purchasing power. You can see here all of the signs that signal contraction, like the Dixie or dollar index continuing to tick up higher here, getting close to our target we shared with the Dash Report group back months ago during the summer. We called for a retest of 106 here on the Dixie, and it looks like we've got a clean uptrend ready to hit that target. So a lot of people have benefited from that here within our newsletter group as we've been setting in these targets, which again is the highest level we've seen since back in November of 2022. Nearly a year of progress in declining the dollar reversed in just a few months. It's incredible how people can get easily caught off guard here thinking that it's completely done with, but in the end it starts to reverse. Along with that as well, another thing we talked about was the reversal here in oil prices. Take a look here. Take a look here at oil prices, up 34% since back here in June. This is also worked hand in hand with the dollar moving higher here, and the Feds need to continue keeping rates higher. We can see a 33% or 1/3 increase in the value of oil back up to $90 a barrel. We talked for months here about whether or not we'd actually get a real close below the 200 week or 200 day, but we got to close above the 200 day, what so many people thought couldn't happen, and it's continuing to charge forward here. We again warned here not to believe that the oil bear market is entirely over here. It may be that that was the high back there in March, but that it can't have a secondary wave is a fool's gambit here. We need to be open to the idea here that oil can reinflate. And we can see here when it comes towards Treasury yields, this is again another sign that rates are moving higher. If Treasury yields are moving higher, we can see that the bond rate for a 10-year Treasury is at its highest level since 2007. For the 2-year yield, it's at its highest level compared to 2006 and 2000. And on top of all of that, we have vast numbers of signs here across the board, whether it's the prediction markets, the Fed's own statements, that essentially those rates are going to keep up higher and longer. And that has started to have significant effects, I think, not only on Bitcoin's performance, but also on the stock market. Yesterday, we had our biggest gap down, and we had follow through on that gap down. It was not bought, it was continued to be sold from that point on. And we essentially saw a decline of 1.6 yesterday within the S&P 500. We saw a decline of 1.8% in the NASDAQ. And as I emphasized towards the beginning of the video, this has pretty much wiped out all of the gains from this past summer. The last 3 months have been pretty much cut out here over the past couple of trading days, at least the majority of those gains for that matter. And what do you know? It was when we faced resistance back here in mid-July, which was the same range here in January and April 2022, where we did not get follow through, where we needed it. We emphasized this a lot, that essentially, even though we've had this really, really strong recovery in price, it can still very well be a relief rally in price. And we need to make sure we can get above those critical levels and make prior levels of resistance new support to signal that we're actually in a new bull market. Unfortunately, we are not getting that here. And it looks like at a minimum here, we're coming down towards the 200 week or the 200 day, which means we still got another couple percentage points here in the near term for price to continue declining, somewhere likely around 7% to the downside for these stocks. And that's the bull market scenario. That's, hey, let's test previous resistance or those key markers as new support. Can we really formulate that? Because if we can't, right, if these essentially do not provide support here, a discount range for these equities, especially considering that from the relative highs, that would be a nice 15% correction. That's usually what you get in kind of mid-cycle corrections during a bull market. 15-20% is very typical, right? If we don't get that and we continue falling forward below that, there's your indication that a recession is around the corner, and essentially that there could be a risk of a depression if the Fed continues to kick the can down the road, as they already have here for a long period of time. That's a big point I want to drive here, guys. You're going to see it across the board in these stocks here, that the argument we've made for a long time in this channel, that the Fed, albeit it is in the right direction of tightening monetary policy, and it's got its eyes focused on the price, it's not doing enough. It hasn't risen rates fast enough. The Fed has not gotten ahead of inflation. And if you need any proof of that, you can take a look at oil prices that shows no end in sight. It's easily heading for triple-digit values here, above $100 a barrel, and it's going to continue to make inflation worse for the Fed and for everyday people. Now, I want to spend some time here to make a very important argument, because oil is at the center of everything here, and it tells one of the clearest stories and addresses one of the biggest misconceptions that people have. So a lot of people come to me and say, Nick, look, I understand you're talking about the Fed needing to raise rates, and maybe they do, but isn't this a bit of an idiotic approach to the issue of oil prices? Because at the end of the day, this really is a supply issue, right? OPEC plus nations are cutting production, and along with that, in the US, we're not seeing the necessary acceleration in production for oil producers. And while I wholeheartedly agree that at the end of the day, this is an equation of supply and demand, and there are problems on the supply side, irrespective of those supply issues, I'm going to go out there and make a very bold claim here. And that is, at the end of the day, the past few months of acceleration in oil prices has little to nothing to do with the supply side of the equation. I'm going to make a very bold claim there, and I'm going to explain why that is. While at the end of the day, yes, more production would help, it's important to understand that in oil markets here, it takes years to begin new projects to actually accelerate the production of new oil. And not to mention, putting that aside here, the past year before this summer, there was a whole lot more. Even the prior 3 months or the past 6 months beforehand, there was a lot more production cuts than what we're seeing right now. And the big thing here that is the ultimate factor is that we suppressed the price of oil. A lot of people believe that oil was just getting towards heightened levels here in June, and that there's a clear reason why oil came down, because it just was a bubble at the end of the day. That isn't true. What we had throughout the past year, since back in 2021 and mainly in 2022, was the use of the U.S. crude oil Strategic Petroleum Reserve. This is a federally managed program where they essentially, over decades, were able to swallow up hundreds of millions of barrels of oil. And this was an essential leverage that the United States had in an event like we're in right now, where it could eventually have some negotiating weight in order to keep oil prices down and apply pressure on the market. Well, the Biden administration over the past year essentially depleted the SPR from around 600 million down to 371 million. It is on course here from where it was back at its relative peak in 2020 to essentially be cut in half. And while it's understandable here that we would use some of this here in the near term, unfortunately, it is only a cushion, a short-term piece of leverage in negotiating with other nations. And unfortunately, as many people have pointed out, we didn't fix the supply issue here. We weren't able to come to the table and essentially get us towards a position where oil prices could come down. And now with the SPR essentially freezing since January, we've depleted by another 20 million barrels, badly enough, but even that, it's a slowdown to the acceleration and the reduction of it, meaning that there's less oil on the market. We can't soften that blow anymore. Well, what's happening since then at the beginning of the year? We've accelerated the higher prices. We were averaging around $75 per barrel at that time to around $78, and now we're sitting at $90 a barrel. It's not rocket science. This is not an issue solely of supply. If we go back, it is an issue of what accelerated oil in the first place from back here in 2020. If we take a look at where we were before the pandemic, we were sitting at $57 to $65 a barrel on oil before the collapse we saw here into negative territory on the futures. And that's what led us to accelerating up here towards a much higher range here. Essentially speaking, it is a monetary phenomenon. It is the over 50% increase in global liquidity that we saw during this window of time between March of 2020 all the way here towards October, November of 2021. Within a year and almost a year, 9 months here, a year and a half, we more than increased the money supply by 50%. The very same liquidity that the Federal Reserve and other central banks printed during 2020 and 2021 that allowed for a secondary massive wave in the secular bull run of the 2010s is going to be the same thing that weighs down the asset prices over the next couple of months as they continue to contract that very same liquidity. We cannot sit here and have a bullish thesis on equities when liquidity has contracted by around $2.4 trillion since back in April, while equity prices have continued to remain elevated since. It was in a complete divergence from the get-go, and it is going to correct here ever more aggressively as it's very clear that global liquidity is going lower here. Now, the big thing here that I want you guys to know about is we've talked about this for months. We've written about this in our newsletter here on the channel, on the Dash Report. We've got hundreds of members, some of our best community members who are part of the newsletter group. And outside of that, we not only have the newsletter where we cover what's been going on here with liquidity and to continue spotting this divergence between both liquidity and valuations, but on top of that, where things are heading here over the next couple of months. And again, we've emphasized this point that the market leaders that many people think are going to win, like Bitcoin or other technology companies like NVDA, Tesla, the FANG stocks, Apple, Microsoft, that they may not be the winners this time around. So if you guys are interested, I highly recommend you guys check out the Dash Report. You can get 20% off if you sign up on an annualized basis. It's a great way to support the channel either way and get that additional 33% of content that you won't be able to get access to here on the channel, such as our trades, our blue-red momentum indicator, etc. But I want to go ahead here and continue diving into this topic, right? I want to go ahead and just kind of show the proof here, guys, because again, I've traded in bull markets before, but to be honest, I think we're all in a camp here that we haven't really traded through a real bear market. I'm talking a 2008 style recession, a 2000 dot-com bubble collapse, right? So I want to go ahead though, because I have studied the history, and I want you guys to just take a look at the charts with me, and I want to kind of, just kind of as a friend to friend here, let's just kind of go one by one here, take a look through some of these different prices and see whether or not we feel the optimism in the air. Take a look at NVIDIA here. NVIDIA being the leading play here on hardware related to artificial intelligence or generative AI, right, has corrected from its peak at $500 down to $410, nearly a 20% correction here. Now, I gotta tell you guys here, if someone doesn't come in and buy NVIDIA soon at $400, that's my big red flag. Because generally speaking, when you're in a bull market, as many people are claiming we're in right now, a new bull market, 15-20% corrections are where you buy these leading names, right? So something's gonna happen here. And after that, if not, then we're hoping to maybe come down to the 200-day and fill in this gap at $300. And if someone doesn't buy it there, then we've got serious issues. We're likely coming back down to the 200 week at around $200. More than a 50% correction in NVIDIA, right? And it doesn't help when Jensen Huang, who's the president and CEO, is continuously exercising options and unloading multi-million-dollar positions here. Now, I understand in some cases options need to be exercised at fixed times. I don't know what the excuse is. Either way, that's not good to see here. That's sell-side pressure. Millions upon millions of dollars that's being sold on a day-by-day basis here when the markets are open. Take a look at Tesla here, right? Tesla set in yet again, it deviated back up here above the line of resistance, right? But again, it's not looking like it's holding here. And looks like it might be yet again another deviation. As we talked about, the more you have deviations here above this line and it's not holding this new support, the likely chance you're going down to prior lines of support in the past. And that is a far cry away from where we are here. And again, I emphasize here, it's not me bashing Elon or Tesla as a company. I think it's one of the few companies that may be doing some really innovative things in the United States. That being realized, at the end of the day, when we come into recessions, we come back to the financials. And it is absurd. It is absurd to see Tesla trading at a 75 PE ratio going into what is likely going to be a recession. It doesn't matter if it's a recession, let alone a depression, a 74, 75 PE multiple on Tesla. I mean, I understand some people say, oh, fundamentals don't matter anymore, yada, yada. They do matter when liquidity is contracting, guys. I gotta tell you. And the difference between a 75 PE multiple and still a very optimistic 35, 40 PE multiple, when you cut that in half, without any change in fundamentals, is Tesla going from $250 a share down to $125 a share, roughly speaking. It can easily happen. And it happened in large part from what we saw back in November 2021 to where we went in January 2023. Just take a look back here at history. Now, if you think I'm crazy that we can't correct from 300 down to say 100, or in this case from 250 down to our target range here for Tesla around 120, or even coming down here to fresh lows at $50, we've done it before. We've done these kind of percentage declines. And again, this is just, it's me trying to help prepare you guys here as best as I can. Because the signs are across the board here, right? FANG, which has had these minor pullbacks here since it really had its rally up until July, has had its sharpest correction here and is now looking like it's set in its lowest level since back in July and June. And is looking steadfast, like it's going for somewhere here within the 200-week moving average at a minimum. This is like me thinking in the optimistic scenario, guys, of where buyers might come in, because they certainly aren't coming in here. Take a look here at Microsoft, right? We've been speaking for months to not fall for the FOMO here in these big tech names, and a clear double top deviation here where essentially all those gains beyond the prior all-time highs were faded. And we continue to face resistance here. Is this bull market price action? Is this the resilience and confidence of blowing through those prior all-time highs, right? If you guys think about that with like Bitcoin, right? When Bitcoin would go past this prior bull market all-time highs, it surges through. And it showcases that confidence when it's in a bull market. But we are not seeing that here in a lot of these plays. And if big tech plays like Microsoft, or oh my God, let alone Apple here, take a look at this monthly candle, 7.4% to the downside here, right? If these stocks, these multi-trillion-dollar assets are moving lower, bond yields are going up, the dollar is becoming more scarce, what do you think this is going to do to crypto? In a world of increased uncertainty and volatility, are people really going to be rushing to Bitcoin? I understand the argument that, oh, with the halving event, cap supply, of course people must go to Bitcoin. But at the end of the day, guys, we see that Bitcoin does best not in periods of time where there is monetary contraction, right? But during periods of monetary acceleration, the creation of new money and new credit in the economy. At the end of the day, I've emphasized this, and I really want to be particular with the language here, guys, because this is a really important point to take home when you're talking to your friends and family about Bitcoin. Bitcoin itself is not a tool to hedge inflation. Last decade, we didn't have any inflation. What we had was debasement of the money supply. There is a clear difference between the two, and I'll explain. And I'm not saying one's good and one's bad. Monetary debasement is when you print new money, right? You print new money, you create new credit in the economy or the money supply expands, right? Central bank balance sheets are going up, there's more QE going on, and interest rates are low, so it's easy to borrow and create more credit off of that original base money. On the other end of the spectrum, inflation is a symptom of that money debasement that can arrive much later, and when it gets towards absurd levels, essentially speaking, when there is more money in the hands of everyday people versus the actual production of goods and services. And that's what we saw with the stimulus checks, with all of the crazy programs, and the amount of money that was made through financialized assets like crypto or stocks with that excess money in the system. And the massive amount of money that central banks printed, where they debased the money supply by nearly 50% globally speaking in less than a year and a half. Now, what you see here, since we've been contracting that money supply in 2022, is that Bitcoin is not really maintaining trend direction, and it's setting in significant lower highs from where it used to face resistance in the past. So again, I get back to this point. Bitcoin is not likely going to be an inflation hedge. We have no proof of this. We have proof that Bitcoin helps us when there's monetary debasement, when we know that the balance sheet has expanded and the core money supply has expanded. That is when it's time to go long on Bitcoin. Unfortunately, right now, we are, at the end of the day, lowering the balance of the money supply. All right, you can take a look at the United States Central Bank balance sheet. The Fed is not pausing here, guys. We are still moving lower here, week by week. And it's not just the Fed. You've got the People's Bank of China. You've got the Bank of England. You have the European Central Bank. So many central banks across the world that are either cutting on their stimulus, or essentially they're cutting back on the decades of stimulus, going through quantitative tightening. And they're raising their interest rates. They're at war with one another, not just to deal with inflation, but to preserve and protect their currencies. And this is having weighing effects on Ethereum, which is still 30% down from nearly a year ago at its relative highs against Bitcoin, and the total market cap minus stablecoins. I want to just come back to this here, guys, because I'm not just talking about Bitcoin. I'm not trying to bash Bitcoin. Bitcoin's been one of the strongest players in the market. Take a look at altcoins, the whole picture. This is total. We're taking a look at Bitcoin and altcoins minus stablecoins. We have not set any new relative high in total market cap since back in April. It's September 22nd right now. I would say the best argument we could look for here for a bull case is that in some way, shape, or form, we are repeating what we saw from February 2019 to June 2019, and then following into March 2020. Hopefully, the best case scenario here for those who've already positioned themselves is that we're going to find support at prior lows at around the $650 billion market cap range, or for Bitcoin, likely around that, kind of 15, 16K range. That's the most optimistic scenario. But if we do not contract liquidity fast enough, if we do not get this over with and get inflation back down, and you're talking about depression level economic activity, I can't tell you guys how low Bitcoin is going. I mean, we've got some levels in mind, but if the Fed really makes that policy mistake, we're in for a lot more pain. And I know a lot of you have come this far in the video, and I hear some of you sometimes asking me, like, Nick, okay, I'd love for you to talk a little bit more about what we can do here. Do we have to short something? Do we have to trade something? Look, yeah, I think at the end of the day, it's becoming very favorable here to short Bitcoin or to short risk-on assets. I mean, big tech stocks are trading a massive premium. You've got that huge divergence between liquidity and current valuations, and that's going to be made up somehow. Either liquidity is going to be printed, which is highly unlikely in an inflation environment. The Fed is not giving any indication of this. Or B, valuations are going to contract. Something is likely going to break in the economy, and that's going to lead valuations of equities to go down. So you can do that if you'd like, if you're a bit more risk on in making trades. But right now, you can just park money in a high yield savings account. You can park money in bonds and treasuries that are paying 4.5 to 5%. Why bother? That's my point here. Why chase, some stocks that are continuously going down in their principal value, but hey, they pay 3 or 4% in dividends? I don't care about that because my dividends are going to be outweighed by the losses in the next month for the stock. That's the point for me. It's there's so many but maybe I could buy something. This is again a big issue that I find from people. And I mean this in the nicest way, guys. I'm only speaking like this as a friend because I don't want you guys to make the same mistakes that I've made over the last couple years and my 12 plus years of trading. I don't want you to make the same mistakes that even a lot of well-minded people out there may be telling you to go out and engage in that'll end up burning you in the end. At the end of the day, you've got to preserve and protect your capital right now. And it is so easy to get in the trap of feeling you need to trade something, you need to make money, especially when you feel the pressures of inflation. But I'll bring back an important message here that we've told people in the Dash report. We've told everyone in our community here that essentially speaking, at the end of the day, inflation is a symptom of that monetary debasement. And the fundamental reality at the end of the day is we weren't all millionaires, right? I'm not saying everyone is at a net worth of $1 million or anything like that. What I'm saying here is that everyone felt like Jordan Belfort. Everyone felt like the Wolf of Wall Street during 2020, 2021. Everyone was changing their profile picture, to all types of financial personalities. And everyone felt like they were, the hottest trader in town, that they were really at wits with the market. But at the end of the day, a lot of us got dumb money because the Fed printed a lot of money. And if we can't admit that to ourselves, then we're going to get caught in traps that will end up losing that money. We're off in an environment where there's a ton of excess liquidity in the system, and therefore we have the inflation we have. To not see those two as directly correlated, as the Fed made the mistake of saying that inflation was transitory, that's the kind of arrogance that'll get us burnt here, guys. And we got to be smart and protect our money. If you made a lot of that easy money, which was likely built off of the hard money you worked hard for from your job, from your company you run, whatever it may be, your source of income, you got to protect and preserve it. No one else will do it better than you. And that's why you got to take what I say, what other people say with a grain of salt. And you got to at least at a minimum turn to the people who have your back, who look out for you on those fundamental factors. And when the times are clearly good, we'll show you how to also make money to the upside. And that's what we're focused on here, guys. That's why I ask if you guys want to support the channel. We're trying to slowly kind of move away from doing advertisements, at least as much as we have done in the past. And I really want to build up the newsletter as the long-term source of income for the channel because for me, it's something I love doing. We give a lot of extra content. You guys can, again, track what I'm doing in the market. And I can't guarantee you guys I've got some absolute formula to make the best returns in the world. What I can promise you is I'm going to do my best to help preserve and protect your capital. And I'm going to help you to capture those next market leader opportunities that no one's talking about right now. Because I got to tell you, time and time again in new bull markets, previous market leaders like the big tech stocks of the last decade, they're likely not going to be the ones that went out, even with the AI narrative here. That's my genuine opinion, guys. Could be wrong on it, but that's for me. I'm looking at a whole range of sectors that are a lot smaller, that have that room for valuation acceleration, and have the ability to really lead transformative change over the next couple of years, that don't already have established revenues and products and services and saturation in their domains. That's what we need to look for. So again, you guys can check out the link down below in the description, get 20% off on an annualized basis. But above all, if you liked my rambling, guys, definitely consider dropping a like. I felt it was necessary for me to finish off on a strong clause here with not only what's going on in the market, but as we go towards the end of the week. I will see you guys next Monday at 6 a.m. Eastern Standard Time. I hope you guys have a fantastic weekend, and I hope you guys enjoyed this video. And if you did, not only consider dropping a like, but sharing it with a family member or friend. Thank you all so much for watching, as always, and give me some time to ramble. And I'll see you guys in the next video. Take care, everyone.